the same type of investment product that led to widespread disaster in the cryptocurrency market in 2022 is proliferating once again. It involves a tantalizing ambition that, in theory at least, sounds simple on paper. Create a so-called stablecoin that tracks the US dollar 1-to-1 while paying investors yields that you're competitive with those available in traditional markets. So the spectacular implosion of the Terra USD stablecoin and the subsequent string of bankruptcies of firms dependent on the nearly 20% yields once offered by a related project. Assistance laid bare how risky such investments can be, yet memories can be short in the crypto world. And as Circle Internet Financial Limited, the issuer of the USDC stablecoin, creeps closer to an initial public offering, and Tether Holdings Limited, the distributor of the largest stablecoin, USDT, builds up its massive reserves. This corner of the crypto market is once again capturing the attention of venture capitalists, founders, and customers. Trade volume for stablecoins and centralized exchanges surged 28% to $995 billion in December, reaching its highest point of 2023, according to CCDI. It's starting to become a category where you have to have a horse in the race, said Martin Carica, Chief Executive Officer of stablecoin company Mountain Protocol. As crypto players aim to profit off of the renewed interest in stablecoins, they've turned to yield-bearing products that some worry may cause the tokens to be much less stable than their name implies. These projects, some of which offer interest rates of more than 20%, have raised concern that holders will be stranded with worthless tokens if the mechanics behind them collapse, which was the case with Terra USD. They've also triggered alarm bells regarding securities regulations in the US. And the yield component raises US federal securities law issues unique to these types of products, which is why the majority of these are offered exclusively offshore, said Michael Sullivan, partnership and at law firm Wilson Farr and Gallagher LLP. While there is currently no federal statutory structure that directly addresses stablecoins, which are typically pegged to an asset like the dollar, CLIG noted that unregulated stablecoin issuers, including those with yield-bearing tokens, typically don't hold U.S. licenses and do not offer their products to investors in the U.S. That doesn't mean Americans are unable to access these digital assets, and they attempt to avoid the registration and licensing requirements by only issuing and redeeming directly offshore, but allowing the stablecoins to flow into the U.S. through secondary sales. There's significant precedent that the U.S. Securities and Exchange Commission considers these types of coins to be securities, according to Ashok Iyer, counsel at Ashbury Legal. He was a December enforcement action from the SEC in which Barnbridge Dow agreed to pay a $1.7 million settlement and cease selling a structured finance crypto product that the regulator found to be unregistered security. Yield-bearing instruments are generally securities, IR said. One company has tried to preemptively work with the SEC to offer an interest-bearing stablecoin, which typically involves the issuer investing funds paid by purchasers of its token and interest standards with no scale and flu stablecoin. And it's an interesting way that it is the idea we have been in a busy to normal for this post-pocket, and the idea that U.S. Bloomberg reported Monday. Yet when assessing the broad landscape of interest-bearing stablecoins, the tokens are on the higher end of the risk curve for consumers, according to Nathan Allman, CEO of Anoa Finance, which offers USDY, a tokenized note, unavailable in the U.S., that's similar to a stablecoin with a variable interest rate. It's a little suspicious whether they're a suitable long-term strategy, he said. And still, these risks and lack of regulatory clarity haven't dissuaded venture capitalists who have poured billions of dollars into the crypto industry over the years, and these days are fielding a plethora of pitches related to stablecoins. At Castle Island Ventures, founding partner Nick Carter said his firm's last 5 deals, including Mountain Protocol, have all been related to stable coins. It's my #1 sector right now, he said, noting that the tokens have much potential for use by fintech companies as well as for remittances and payments on mobile apps. Carter said he's particularly excited about interest-bearing stablecoins. He said these products are gaining traction in Latin America, where customers may not have access to stable currencies, U.S. banking creative accounts, money market funds, treasuries, or other savings. The target audience is basically middle or upper class folks in emerging markets that just don't have access to dollar rails at all. He said Mountain Protocol's Carica got into stablecoins after experiencing inflation and currency instability in his native Argentina. Domiciled in Bermuda and regulated by that country's monetary authority, Mountain Protocol launched its USDN coin in September. The token, which Mountain Protocol doesn't offer in U.S. customers, can provide interest rates of around 5% and is now the 12th largest stablecoin by market capitalization, according to crypto data tracker Defilama. 45 and Mountain Protocol is an effort to build the closest proxy to a high-yield checking account for the world. Carica said, and some people within the crypto industry have PTSD following the collapse of Terra USD and its sister Luna token in 2022. According to Carica, the depegging of the true USD stablecoin from the dollar even sparked flashbacks earlier this month. And Carica said Mountain Protocol has taken steps to prevent a similar debacle and has a wind-down plan in place. From a solvency perspective, we always aim to pay less than we're making on the asset side, he said. Other startups are more hesitant to classify their products as interest-bearing stablecoins amid regulatory uncertainty. Portugal-based Athena, its USDE currency, with which investors can earn a yield VOC, a related app as a stablecoin in July before in October. The company, which recently raised $6.5 million and is about to announce an additional round of funding, now prefers the term synthetic dollar, according to CEO Guillaume. USD is currently available to VCs and hedge funds, but FNA plans to publicly launch the token by the end of the month. According to Young, he said the company uses customers' staked ETH as collateral. Staking ETH involves locking up tokens to help manage the proof of stake network in exchange for payments similar to the rewards paid to Gitcoin miners. We take that collateral, send it to a custodian, and hedge exposure on an exchange, shorting exposure to the same asset, he said. The yields earned from this strategy and get passed on to users through the Athena app, which is not available in the U.S. Yields for USD reached 26% in December before falling to the high teens this month. According to Young, the risks of this product look very different to a normal stablecoin, Young said.